Hello, I'm Robin Gibson, and this is your Harvard House Money Morsel. Hello, everybody, and welcome back. Please don't forget to like and subscribe and click the bell so you get the notifications of our videos. I'm sitting again with Michael Porter, Chief Investment Officer of Harvard House. Welcome, Michael. Thanks for joining us.
Morning.
Michael, on Wednesday, the Fed raised interest rates, as you were talking about in last week's video, and the market boomed as a result of that. And then we saw it slump last night, and that was Thursday, the 5th of May. Please tell us what's going on.
Robin, sure. Where do you start? It's a crazy world out there. So on Wednesday, the Federal Reserve, as you rightly said, raised interest rates by 0.5%. I think the first thing to note is that is the first time they've raised interest rates by 0.5% since 2000. Normally, they only raise interest rates in increments of 25 basis points. So that is a big move in relation to history. In their statement after the meeting, the Federal Reserve said that they had no intention of raising interest rates by 75 basis point increment, which the market had been fearing that maybe there was going to be a 75 basis point hike coming at the next meeting. And so the market boomed thereafter. Absolutely took off, sort of 3 or 4%. The Fed is more dovish, as they say, than what people were expecting. Come Thursday, I think the market just really settled back into focusing on inflation. Inflation hadn't gone away. There were some statistics out of America yesterday which essentially showed that unit labor costs had risen by 11.5%, and productivity, which is essentially, I suppose, the difference between your sort of growth in GDP and your growth in labor costs, the productivity of your workforce fell by the largest margin, I think 7.5%, since the 1940s or the 1950s. It was a big number like that. And I think that just really focused people's attention back on the fact that there is high inflation, that growth is slowing. In addition, there were some corporate results, especially on the tech side. There's no doubt that the whole COVID bubble is working its way out of the system. So companies that did extremely well during COVID, as everybody rushed online, the world is normalizing. People are going back to tech has got its place, and tech has certainly become much more ingrained in our lives. But people are returning to some old habits. So that extraordinary growth bubble is coming to an end, and then companies are settling into a more normal way. So Shopify or an Amazon or all these companies are still growing, but they're not growing as quickly as they were. And there's obviously a big base that they're now, a much higher base that they're sort of growing off. So the market is a bit concerned about that. In addition, you've got US bond yields rising, which is essentially a function of interest rates and expectations about interest rates. I just want people to stand back for a second and think about it. At the start of the year, US 10-year interest rates were at 1.5%. They are now at 3.05%. So if you think that bonds are a safe investment or a low-risk investment, you need to think again, because you haven't just lost half your money. The way bonds work, if your yields have doubled, you've lost probably 70% of your capital, on bonds. So bonds are not risk-free. The 30-year bond in America is now 5.2%, and that is really the rate at which mortgages are referenced in America and things like that. They don't reference to a repo rate like we do. They reference to a 30-year bond rate. And so, mortgage rates are rising to the highest level. You will see a cooling down of the housing market. And I think the market's just really concerned that the Federal Reserve, having been a little bit behind the curve, is now going to raise interest rates too aggressively and thereby induce a recession. The Bank of England also raised interest rates yesterday, but because the Federal Reserve is being more aggressive than the Bank of England, the pound weakened, the dollar is going through the roof because everybody's rushing to dollars. I mean, the interest rates are rising, and because the dollar is so strong, the rand is under pressure, commodity prices under pressure. So it's just this sort of big cement mixer, everything getting thrown in and getting churned around. But it's really all just comes down to the fact that rates are rising in America.
And that sort of really echoes our views, Harvard House. We've always said that in a rising interest rate environment, bonds actually lose you money relative to inflation. whereas equities are the only instrument that has beaten inflation over all cycles, both rising and declining rate cycles.
Yeah, so I mean, obviously, why equities are so volatile, and I mean, the Nasdaq is down 20% this year, is that during a phase where you're having a transition, I suppose, from low interest rates to high interest rates, markets can be very volatile. But shares do have pricing power. Companies do have pricing power. So if we look at all the results that are coming out, generally speaking, there is margin pressure, but companies are starting to raise prices to obviously claw back that margin pressure. And that's basically why you want to invest in shares, is because they do have the ability to claw back that margin, to put prices up, and to protect themselves from rising prices. But there is a lead and a lag. So you find now that everybody's focused on margins, and then, profits aren't as good as we expected, and there's a bit of margin pressure. But in 2 or 3 quarters' time, obviously, that'll start to turn around again. So you've kind of got to stay the course, but it's it's a bit of a roller coaster ride during the process.
Well, definitely. I mean, it's a really great example. Markets and the way Michael talks about them are a great example of the butterfly effect. Little butterfly movement here, big storm over there, and that's the world we live in. Please don't stop tuning in. Keep joining us to keep up to date with what's happening and really understand these movements as we delve into the brains of our asset managers and team that are here to support you. Thank you for joining us. Thank you, Michael.
Thank you.